Hello again, everyone. This is Shiraz Madan, CEO of Sustainable Capital Finance, and it looks like we have a full house today, a lot of familiar names in attendance, and some new ones that I look forward to getting acquainted with. We have a lot of information to share today, so let's dive right in. In today's webinar, I'll provide an overview of SCF for those that are less familiar with the company. I'll outline the value proposition for both solar-powered fast chargers and a net metered PPA for commercial property owners. We'll summarize the differences between the existing NEM 2.0 program and its evil sibling replacement, NEM 3.0, and why there's urgency to get projects into NEM 2.0. We'll discuss the spike in demand for fast chargers due to EV adoption, our unique system design. Will quantify and illustrate a potential revenue stream for commercial property owners and take you through a demo of how you can quickly receive indicative terms for a project on your property within minutes through our proprietary cloud-based software, the SCF Suite. We'll finish up with next steps and some Q&A. SCF is a third-party financier for C&I scale solar, energy storage, and fast charging infrastructure projects. We work with businesses, schools, municipalities, and other tax-exempt entities in providing energy as a service. We work with installers and developers and provide development collaboration as well as takeout financing solutions for their projects. To date, we have contracted over $200 million in distributed generation, which includes solar, energy storage, and fast charging. And lastly, we work in collaboration with some of the market's largest independent power producers, institutional investors, and asset owners. The value proposition for a commercial real estate owner adopting fast charging infrastructure on site is very straightforward. EV adoption has grown considerably across the U.S., but specifically in California. By installing fast charging infrastructure, property owners can realize immediate value in the form of a revenue share from public fast charging, a reduced energy spend to the house meter and or community meters. There's a new property feature to offer both tenants and customers. The new amenity will certainly attract new customers that may not have been patrons prior to a charging station being installed. There's no investment needed on behalf of the commercial property owner, no installation or maintenance needed, and there's a peace of mind knowing that SCF and its capital partners are financially viable and have the experience to deploy distributed generation assets on site. I mentioned on the previous slide that one of the value propositions for this solution included a reduction in energy spend for the house meter. Through the existing net energy metering program, we're able to install solar energy and EV chargers and provide solar generation to both the chargers, and then for any production that is not utilized by the chargers, offset the house meter or community meter for the facility itself. So that means a direct reduction in operating expenses for the facility, which results in an increase in NOI. Once again, there is no upfront cost or capital expenditure on behalf of the property owner. SCF will maintain the system for the term of the contract. And once again, if a customer is tax exempt, SCF can still provide third-party financing and ensure the tax benefits are monetized while passing along a lower cost of energy. With all that being said, I'm going to pass it over to my teammate Dan Holloway, who will discuss the differences between NEM 2.0 and NEM 3.0.
Thanks, Shiraz. As Shiraz mentioned, my name is Dan Holloway, and I head up our originations and acquisitions team here at SCF. So let's dive right in. The term net energy metering, or NEM for short, is a term that describes how some utilities manage solar energy that is exported to the grid. And the way it works is that when a solar system is producing more energy than a facility needs, that remainder is exported back to the grid so that other utility customers can take advantage of it. Historically, the energy that is sent back to the grid is credited to the owner of the solar system at retail rates. Under the current NEM rules, which is a program called NEM 2.0, customers in California have historically received, on average, about 30 cents per kilowatt hour for any electricity that they've exported back to the grid. However, a new rule was just passed this January called NEM 3.0. And under NEM 3.0, the rate that utilities are required to pay for exported electricity is something much closer to wholesale rates, and is estimated to be only about, it's around 8 cents per kilowatt hour, which is 75% less than customers received under the NEM 2.0 program. And this kind of huge reduction is going to have a significant impact for all new solar systems that are installed after the new NEM 3.0 program is implemented. So currently, the final date that a project can be approved and grandfathered into the NEM 2.0 rules is April 13th of this year. This means we have a very limited time to offer the current PPA/EV charging revenue share program that we're covering today. And once NEM 3.0 goes into effect, we will have to adjust potential PPA rates, revenue share percentages, and most likely have to add storage to a number of future projects to make them pencil. So we just wanted to make you aware of this because there's still time to get some projects under the NEM 2.0 wire, and we definitely want to make that happen if possible. So what has to happen to get under the NEM 2.0 wire? Well, there are a number of things, so let's go through them here. First off, a site license agreement must be executed between SCF and the property owner. This agreement basically allows SCF solar and EV charging equipment to remain on the property for the duration of it. Prior to signing this agreement, we will, of course, provide a term sheet summarizing all the pertinent deal terms, and we'll be sharing that with the property owner. Secondly, an interconnect application must be filed with the utility. If we receive an approved interconnect reservation from the utility, we can then be grandfathered into NEM 2.0. An interconnect agreement, for those of you who don't know, allows us the right to attach our equipment to the utility's grid. And this application requires a few things to get accepted. So we're going to need a single line electrical diagram, we'll need a meter number, a copy of the signed agreement itself, and finally a completed interconnect form. All of this work takes roughly 4 weeks to complete, and all we need to start this process is simply a signed term sheet, as I mentioned earlier. Based on this timeline, we will need projects to be submitted by no later than the end of February to have a really good chance at getting grandfathered into the NEM 2.0 structure. Any later than that, and our chances of falling into NEM 3.0 go up pretty significantly. So just to keep in mind, the end of February is going to be the target date to get projects submitted. So the reason we're so excited about the EV market is really broken down within this next slide here. Let's start off by touching on some of the highlights of the electric vehicle market for 2022. First off, 2022 was a heck of a year for EV sales. The most interesting stat in my mind anyways is that over 20 automobile manufacturers launched their very first EV model within 2022, with some launching more than one. EV sales topped 900,000 units in 2022, up by more than 65% from 2021. EV sales as a percentage almost doubled, going from 3.1% in 2021 to 5.85% in 2022. And based on current growth projections, EV sales are expected to reach more than 50% of all U.S. cars sold by 2030. And just based on 2022 sales volume of 14 million units, we would expect to see that by 2030, more than 7 million EVs will be hitting the road in just that year. And when you add up all the EV sales between then and now, you're going to have something north of 15 million EVs on the road by then. That, my friends, a lot of EVs, and all of them are going to need to be charged, and they're all going to need to be charged pretty regularly. So let's see what's happening on the EV charging side of the coin. In 2021, there were a total of 114,000 publicly available charging stations in the US. Of those, 22,000 were what we call fast chargers. We denote those as chargers that have a capacity of between 50 and 250 kilowatts. And 92,000, or the remainder of those, were level 2 chargers. And those typically only have a 10 kilowatt charging capacity. So pretty broad disparity between the two types of chargers. To simplify it, a fast charger can charge a typical EV in, let's say, 20 to 40 minutes, depending on a bunch of different variables, whereas a level 2 charger is going to take you anywhere from, let's say, 6 to 10 hours to charge the same vehicle. If you were to compare the total number of EVs on the road today, about 2.3 million, versus the total number of publicly accessible chargers available, about 114,000, you would see the ratio is more than 20 to 1. Another interesting stat here is that while the number of publicly accessible chargers grew by 40% last year, pretty substantial, the number of EVs sold grew by 65%. So the EV charging market is actually falling well behind the EV market itself. Bottom line here, we simply need a lot more chargers out there. And so that's what we're looking to promote here. All right, so let's talk about what makes a good location for EV chargers. So during our investigation into the EV charging market, we found that there are a number of factors that kind of lend themselves to charging stations that have high utilization rates or ones that get used the most. So let's go through those. The first factor is areas that simply have a lot of EVs, and we can determine this through some publicly available data that we have access to that shows EV sales by zip codes. You can also just look out in your parking lot and see if there's a bunch of EVs out there. If you live in California, there's a good chance that's the case. We're also looking for sites that have a decent amount of traffic based on the business that is located there. So if you have a mall or a restaurant and there are already a lot of people visiting your location, and some percentage of those are going to have electric vehicles, the chargers themselves will bring in additional customers, but it's nice to have a base of customers to work off initially. We also look for sites that are close to major traffic arteries. Those are also very high on our list. We don't want people to travel, a long way from their current traffic patterns and trying to look for an EV charger. If a site is only a half a mile from the freeway, this one will be superior to one that is, let's say, 5 miles from the freeway, all things being equal. And lastly, we need enough room to install solar on each site. And that can be done on the roof. It can be done on carports. And, we will have to look at potential usage on site and a number of other factors to determine the right size of solar system that each project would need. But we're going to have some space to put solar on the site. So now we get into the numbers. We've put together a pretty representative project so you can see what all this equipment actually costs. In this example, we would be installing 400 kilowatts of solar on a carport in the parking lot. And then in addition to that, we would be including 4 180 kilowatt fast chargers as well. When you add up all the equipment costs, the installation, permitting fees, etc., the total cost of this system would be about $1.76 million. We just wanted to share this with you so you had some idea of kind of what it would cost to install a system like this. So what does all of this mean to you? In this example, we're providing both a power purchase agreement as well as a share of all the EV charging revenue. For this project, we're providing a 10% share of the EV charging revenue and a PPA rate that would provide a 10% savings from the property owner's current cost of electricity based on the amount of electricity we ultimately send to their facility. Please understand that whatever electricity is generated by the solar system, it can either be sent to the EV chargers, it can be sent to the facility, or to both. So what that means in terms of dollars is shown in the yearly figures just above the graphs. In year one, we assume that it's going to take some time for people to find out that a fast charger has been installed in their area. That's despite the fact that all of our chargers show up in all the main platforms such as Charge Hub and PlugShare and ChargePoint, etc. But it can still take a few months for people to build the new habits to continually go to the site. With this in mind, we're estimating that about half the electricity created by the solar system will go to the EV chargers, and the remainder is going to go to the building on site to offset their electricity usage. So between the two, you've got about $5,000 being generated in PPA savings to the property owner, and you also have an additional $17,000 generated in EV charging revenue, which equates to 10% of the total revenue generated. When you combine both of these amounts, the property owner would pick up a total of about $22,000 as a combination of both the savings from the PPA and the EV charging revenue. And this is all with no out-of-pocket expenses on their side. So think of it this way. It's like a way to monetize parking spaces that you currently provide for free. And then in year 2, we assume that the EV chargers will gain more usage as more and more people realize they're there, and because the number of EVs on the road will actually have increased pretty dramatically in that year. By the end of year 2, we're estimating that all the electricity generated by the solar system will then be used by the chargers themselves, and none of it will be going to offset the building usage. And just be aware that the revenue generated by the EV chargers is substantially greater than the savings generated by the PPA, so this actually ends up being a great thing. So based on our estimates, the property owner would generate over $45,000 in EV charging revenue in year 2. And you can see where the rev share numbers go from there. They go up at a pretty decent clip each year, just as more and more EVs hit the road each year. And then please note that the better the location, the higher these numbers will go, and the property owner gets to share in all of it. So it's an exciting market. We're trying to offer something I think that's really unique by offering both charging revenue and PPA revenue. So just consider it and think about it quickly, because time's ticking on the NEM 2.0 stuff that's coming. So with that, I'm going to hand it off to my colleague Joel Binstock. Joel, take it away.
Thanks, Dan. This is Joel, and in the operations team, my goal is to get projects energized faster. The easiest way to expedite the development cycle of these large projects is to simplify that process. And that is what we strive for here at SCF. The initial steps are completed through the SCF suite, and I'm going to quickly go through the first with you. Just a friendly reminder, there are no subscription requirements or fees, just that the property or properties being reviewed are commercial in scale. So after this webinar, you'll receive a suite registration link, and that's where I'm kicking off right here. The registration page is simple. You'll enter in your company or organization's name, followed by the site address and some phone information. I'm going to use Sustainable Capital Finance for this example. Next, you'll be providing a preferred username along with your general contact information. Here on the project info page, you'll select the project type between solar PPA, EV charging revenue share, or both. I'm going to select both for this example. The first question is, what is your average annual electricity spend? In this case, we'll assume $1 million per year. This question is, how many EV chargers would you like to have installed? It gives an approximate range of several options. Just select which best suits your needs. The last question is the intended use of the chargers, whether it's public use, private use, or mixed. For this, we'll use public use. Lastly, for the security info, you'll just fill out the CAPTCHA. Afterwards, an SCF representative will review your registration and activate your account, prompting an email sent to your email on file with login information. Please don't forget to check your spam filters, as sometimes that email can end up there. So now that you are approved to utilize the suite, you'll be prompted to go to complete the initial information gathering. And first is the Customer Details tab. A lot of this may feel familiar, but it's important to note that sometimes the site of the project is different than the headquarters or mailing address of an organization. In this case, we're again going to populate using SCF's headquarters. Next is the utility details. Here you can enter in the utility provider, your average annual electricity spend, and your previous 12 months of kilowatt hours consumed. But what's most important is your ability to upload utility bills here to our data room. If you're having trouble locating your bills or uploading them to the SCF data room, an SCF project analyst can assist. The reason the bills are so critical is that so that we can design and size the solar and EV charging solutions accurately. The cost of power specific to your site will greatly impact both the savings as well as charging revenue that SCF's solutions can support. And lastly, on the customer information page is the schedule, where you can work to coordinate an introductory call with an SCF project analyst. And once that all is complete, simply click Save and Continue in the top right corner. And I'm going to go ahead and transition back over to our PowerPoint. So once SCF's project team receives that notification that a project is ready for review, they will review your utility bills and site information and reach out to coordinate that introductory call. During this call, the SCF representative will present the various options to the customer and answer any initial questions. If the customer is interested in proceeding, a letter of intent will be populated and sent via HelloSign to digitally sign in the SCF suite. After the term sheet is executed, SCF will finalize diligence on the design, real estate, title, preferred installers, and equipment. Simultaneously, the various contracts will be sent out for review and execution. This simplified process enables our customers to execute agreements in as little as 30 days from initial design, and it enables our installer partners to mobilize and energize systems faster than ever before. So that about wraps up the end of our presentation. Next is a Q&A session. If you have questions, please submit them in the question box, and we will try to get to all of them. If not, they will be added to the FAQ section in the SCF Suite support section. So with that, why don't we jump in? So there's several new construction businesses, and someone is wondering whether or not new construction would be a good candidate for solar and EV charging. Well, specifically in California, there are a lot of mandates that require certain types of commercial structures to have solar. There are also a lot of advantages for us to get ahead of construction when it comes to from the construction standpoint of these interconnections. We can help to make sure that the panel is properly sized to handle solar EV charging as well as the existing or expected load from a new construction. In terms of with regards to the lack of utility bill information from those types of customers, what we would need is an energy audit report. Those are typically completed by third parties to calculate the expected load from the new construction, right? So that would be the kind of information that we need to properly size a solar to a new type of construction. Good question. Someone had a question with regards to energy storage. So in terms of energy storage, there are only a few states where it could be advantageous to integrate energy storage. Batteries typically, in terms of space, they do require a little bit of space. In terms of a 250 kilowatt kind of 2-hour battery, you're looking about a quarter of a parking space. So that's the type of footprint that kind of battery might have. But there's really going to be a use case basis on whether or not energy storage is going to be integrated into these types of solutions. Traditionally, solar is obviously going to allow us to generate high value electricity
for both the chargers and to offset existing usage. Storage can be advantaged, particularly when it comes to demand charges. So if there is a existing rate tariff that the customer is on that has extremely high demand charges, we could absolutely explore if energy storage is a good candidate for that. When installing EV chargers, do we typically tie into the new, essentially into the existing service, or bring on a new service? And at what point do we recommend bringing a new service? Yeah, so it really is a case-by-case basis. In general, going forward, we're typically going to provide a new service. It will particularly help with, it really depends if the utility allows for virtual net metering and if we can credit an existing service with generation credits generated on a new service, right? So that is going to be kind of a case-by-case basis based off of the utility and specifically the rate tariff that they're on. But ideally, we will interconnect if there is a lot of behind the meter existing load and we are unable to virtually credit, then we would like to tie into the existing interconnection point to offset as much existing load to help save as much electricity and energy spend for the customer. Alternatively, we could put a new service in, and that allows us to kind of not tie into the existing load, particularly if there are some panel restrictions or interconnection limits on that existing interconnection. In terms of equipment, typically we have a tier 1 list that is available on the SCF suite. For our vendors and developers and installers, we are going to essentially work with them to review any sort of spec sheets or letters of warranties for equipment that is deemed tier 1 but is not on our lists, so we can make sure that we stay up to date as well. I have a question about Texas, Louisiana, and North Carolina with regards to interconnection policies. So on a state-by-state basis, it's a little bit difficult, but Texas has relatively easily accessible interconnection policies. I'm not very familiar with Louisiana, but North Carolina specifically under Duke territory, there is no authorized third-party sale of power, so we cannot operate in Duke territory. And then specifically outside of Duke territory, you're kind of beholden to the rural electrical municipal co-ops or the REMCs. So that's going to be on a case-by-case basis, but those are those markets. In general, a good rule of thumb is if the avoided cost of power or the cost of power is generally around 10 cents or higher, there's a good chance that solar can work in those markets. And if the cost of power is lower, then you're going to need typically local incentives to help sort of incentivize and boost the economics on those types of markets. In terms of federal funding for communities, I think you might be meaning in terms of tax credits. We will monetize all the tax credits associated with the solar as well as the EV charging. And there are adders based off of the new IRA legislation based off of low income and disadvantaged communities, as well as domestic product adders as well. And so we will review with our installers, our equipment vendors, as well as the customer to make sure we monetize and maximize the value of the tax incentives for all the equipment so that we could make sure the economics are as advantageous as possible. How many miles off of a main highway in a rural area is acceptable for a charger? Right, so that's going to once again tie back to the state-by-state market. So, in California, that may be very different than in a rural state like Ohio. But in general, you are going to want these to be high traffic locations, right? That's going to boost the economics. We can complete analyses based off of kind of a reduced expected usage and see if it's economically viable. But I would anticipate that if it is quite, 3 to 5 miles plus off of a highway or any sort of kind of large, urban or suburban hub, it's probably not going to be advantageous for level 3 chargers. Just a few more questions. Really appreciate everyone staying on this long. So Maine, Nevada, and Pennsylvania, I had some other follow-ups. Maine, that should potentially be an economically viable market. We're going to have to look specifically at the state level for EV charging based incentives, as well as if there are credits associated with the sale of, or the charging credits associated with LCFS or fast chargers. And yes, that's Ian, that's kind of why I brought it up right there. Our California models assume the collection of the LCFS credits in if it's applicable. And then if there's other markets where those types of credits are applicable, we'll add them onto the SCF suite. And it's really case by case. But right now, California is currently the market with LCFS credits built in. Just a few more questions we're going to get through right now. I know we're running past our time a little bit. And once again, do apologize for the audio difficulties. We'll try to make sure we get that cleaned up during the recording and send that out so you can share that with your colleagues or interested parties. So I have a question with regards to kind of like whether or not there is a value add between using the revenue share model for the chargers versus kind of exclusively benefiting from the PPA. There are cases where we can run an analysis, right, and dictate that there's a lot more value to be had from adding substantial amount of solar and avoiding EV charging altogether. Historically, SCF has been a solar PPA financier. So in markets like California, Arizona, Ohio, New Jersey, the Northeast, we have been active in kind of PPA markets and selling power under the cost of power to customers. And now as we kind of move forward into EV charging solutions, we'll see those solutions being integrated. But absolutely, we think first and foremost, we're going to size the solar appropriately to generate as much value because ultimately the solar is going from a value add is going to drive the economics, particularly when it comes to integrating some of these level 3 fast chargers where the cost of power would be significant. Excited to hear back from a lot of you guys. I saw the messages. These are our contact information. Feel free to reach out. Another one of our sales rep is Matt Brown. That's mbrown@scf.com if you're interested in reaching out to one of our sales reps. And yeah, we really, really appreciate it. There are some additional questions that I haven't been able to get to. But with that, I'll be adding them to the FAQ section of the support center in the SCF suite, as I mentioned earlier. So feel free to look out them there. And so with that, thank you very much, everyone.